Welcome to another episode of Coffee with Alissa. Today we'll be discussing the Big Beautiful Bill Act, and to do so, I'll be interviewing Christine Green, tax attorney and member at Steptoe and Johnson here in Pittsburgh. There's so much wrapped up into this act, but we wanted to touch on some key points today. So, Christy, thank you for joining me. How are you today?
Thanks. Very happy to be here. Super excited to discuss this.
So on July 1st, Vice President Vance added the 51st vote to pass the Big Beautiful Bill Act, which is now the Big Beautiful Bill Act. It went through the process and was enacted, but this was done through reconciliation. So that's, a legislative process that allows Congress to pass certain budget-related bills with a simple majority in the Senate, 51 votes, instead of the 60 that are required to overcome a filibuster. So can you talk a little bit about that tax policy when using reconciliation and how that works?
So I'll just start off by saying that good tax policy does not come from reconciliation. Reconciliation is a tool that increasingly is becoming used to pass tax legislation because we've had such a divided government for many, many years, and things seem to always be getting kind of more divided. So reconciliation, again, you only need 51 votes in the Senate, you don't need 60. So it opens the door, right, for legislation to happen. The key thing with reconciliation is that it's all focused on the budget and the national deficit. So when I talk to the general public, members of my family, they think that members of Congress sit around and try to come up with what would make sense for tax law, what actually makes sense, or what's fair. And what I always say is that's not what they're doing. They don't care about what's fair. And the reason they don't care about what's fair is because what's fair for one person isn't fair for someone else. And when you're doing reconciliation, the focus is not necessarily on, okay, what's our ideal set of tax rules or ideal set of law. Instead, what happens is every provision that's in that type of legislation where reconciliation is used has to impact the budget, the national budget. So what happens is every single provision gets scored by the Joint Committee on Taxation, and they look at that to see, would this type of provision increase the national deficit, or is it actually a revenue raiser and it would help decrease it? So traditionally what's happened in reconciliation is, maybe Congress starts off and they say, okay, we're going to do a reconciliation tax bill. And we're going to say that for the next 10 years, we want this to land on the scoring where the deficit will not be increased, which means that every time they give somebody a new deduction or they increase a deduction, right, they have to find an offsetting pay for, which means they've got to raise a tax rate or they've got to remove a deduction for somebody. And the other thing you see with reconciliation is that you see sort of these weird windows where certain tax laws might, instead of lasting forever or be permanent, they might have a sunset to them. So they might, end in 3 years or 4 years or 5 years. And that's all because of that budgetary scoring. It's really what's going on in reconciliation. And that's how we kind of end up with a very complex set of tax rules with, seeming losers and winners and the general public going, wow, this doesn't make sense. What do we do with this? So it's very complicated, but it's becoming a lot more common that reconciliation is used for tax law.
And you mentioned things that sunset. So I think the first thing that comes to my mind is the Tax Cuts and Jobs Act, right? That was enacted during the first Trump presidency term. And I think that, so that act was extended. Can you talk a little bit about how that translates to a person's bottom line?
Yes. So in 2017, we had the Tax Cuts and Jobs Act, which at the time, made a lot of significant changes to the tax code. Budget reconciliation was used to pass the Tax Cuts and Jobs Act. What that meant is that a lot of provisions in the Tax Cuts and Jobs Act had these kind of weird sunsets in them. And that was because, right, they couldn't, they had to look at the numbers and the scoring and make sure that they weren't going to increase the deficit beyond a certain time frame. Well, a lot of those provisions were set to expire at the end of this year. So, when President Trump took office, there was a lot of speculation. Everybody was wondering, oh, what's his agenda going to be? What's Congress going to be focused on? And my sort of joke was tax. Tax is the agenda. That's what that's what the president's focused on, because they have to be. The reality is, if a lot of the provisions in the Tax Cuts and Jobs Act were left to expire at this end of this year, and Congress did nothing, the reality is that a lot of people would see their tax bill go up next year, and most of the general public would be unhappy about it. Now, I know that right now, the news media, the public perception of the big, beautiful bill is negative, largely negative. Most people are viewing it as it's a giveaway to billionaires. I don't think that's quite fair. There's certainly, tax cuts in it, but I don't think that's quite fair, because the reality is a lot of kind of average people, if the Tax Cuts and Jobs Act were to expire, would see their taxes go up. So with the big, beautiful bill, a lot of the provisions in the Tax Cuts and Jobs Act have now been extended and made permanent. And we can talk about what permanent actually means. But things like the top marginal tax rate for individuals, it used to be 39.6%. The Tax Cuts and Jobs Act reduced that to 37%. It was scheduled to sunset at the end of this year, but now under the big, beautiful bill, it's made permanent to be at 37%. So that's just one example. Another one that I like to talk about is the standard deduction. So back when the Tax Cuts and Jobs Act was being debated, albeit for a very short time frame, one of the goals that congressional Republicans and the president had at the time was they wanted to massively boost the standard deduction, because they wanted to simplify tax return preparation for individuals. And at the time, they kept referencing like a postcard, where you could just, fill out a postcard and that was your tax return. And the idea was that if you had less people itemizing and more people claiming the standard deduction, it would simplify their return. So the Tax Cuts and Jobs Act doubled the standard deduction, but again, that was set to sunset. But now with the big, beautiful bill, that has been permanently extended. And those are, a few of the examples. There's a lot of other things that the big, beautiful bill does. Aside from extending a lot of the things in the Tax Cuts and Jobs Act, there are some new things thrown in there that are worth touching on. So there's a new deduction for tips, and that deduction basically functions so that up to a certain threshold, $25,000, you won't end up paying tax on tips. There are some guardrails around that. There's a phase out at certain income levels. There's also, rules. I have had people ask, oh, well, everybody's going to claim all of their income as tips. I'm like, no, there's some guardrails put in there. You won't be able to do it. Similar with overtime, there's now a deduction for up to $12,500 of overtime wages. And that deduction functions effectively so that that amount will not be taxable to an individual. So really, this big, beautiful bill, there's so much in it. Tax professionals are still really diving into it. And it certainly did the main thing of extending the TCJA, but also there's a lot of different provisions in there.
Absolutely. And one of them was the extension of the estate tax exemption, and a little bit of an increase there. So starting next year, $15 million exemption for individuals, $30 million for couples. The majority of people, I would say, never hit this number, but if they do, there's a 40% federal estate tax on the assets above that exemption. So do you have any planning recommendations from a tax perspective that people should be thinking about? Especially, I would think people that are maybe more like cash poor but asset rich.
Yeah, so the estate exemption is something that throughout history has flip-flopped back and forth all the time. And you can definitely see how this would be a target in the future if we have a change in administration, change in Congress. This could be a target. So even though the big beautiful bill, made the sort of increased exemption amount permanent, it's not scheduled to sunset, it could still change in the future, right? Congress could come in later and say, no, we're changing this, we're getting rid of this. So I think the biggest thing is don't, waste time, start planning now. If things that people are doing are definitely finding counsel, exploring different sorts of trust options. Another thing they're doing, if they have a family business, succession planning. You maybe want to start gifting some of that equity to your children. If they're going to take over the business, you can do those things now. And something else that's becoming interesting, because that exemption is so high right now, a lot of sort of, people with higher assets, but maybe cash poor, are looking at some income tax planning as well. And one of the things that's going to become very popular is probably the use of non-grantor trusts. So if they have assets that they maybe don't need, unfettered access to, they're probably going to start using some non-grantor trusts. And that's because non-grantor trusts are viewed as their own separate taxpayer, and they're able to claim other benefits and tax deductions. And we haven't talked about it yet, but I know we're going to hit on it, which is the state and local deduction, the SALT cap. And so non-grantor trust, that's a separate SALT cap for them versus a grantor. And so that is something that I've already seen estate planners are out there saying, oh, I need to meet with my clients and talk about non-grantor trusts and how we can really use income tax planning to kind of match with the estate side.
Well, let's hit that topic right now, since you brought it up. The SALT deduction, that's a big topic. It was capped under the TCJA at $10,000. That hurt a lot of working Americans and people that are in like high tax states.
Right.
It's been raised to a $40,000 cap, but is it as beneficial as it sounds?
So time will tell how this will shake out. I think for a lot of taxpayers, they're going to need their advisors to kind of run the numbers to see where they fall. So the SALT cap is, interestingly enough, right, it was one of the huge pay-fors when the TCJA was passed. It was one of the ways that all the other tax cuts got paid for under reconciliation. And then we fast forward to 2025, and the SALT cap kind of dominated the news and was one of the main points of contention among congressional Republicans. You had some people that thought it was great, from low tax states, others from high tax states, and my constituents hate this, we have to increase this. And so the Republicans eventually sort of coalesced around, well, let's bump it up to 40,000. A couple things to know about the SALT cap. The SALT cap under the TCJA was supposed to sunset at the end of 2025. Now it's at 40,000, right? But it's going to go back down to 10,000 in 2030. Now, obviously, Congress could change the law between now and then, and that could change. We'll see. The other thing is there's a phase out. So once you have income over 500,000, the SALT cap starts to phase out. And right now we're seeing a lot of calculations done between that 500,000 and 600,000 and showing just how bad the phase out is, kind of how damaging it is. So if you're in that range of income, you definitely want to kind of talk with your advisors ahead of time so you don't get surprised next year at tax time. The other thing with the SALT cap is that a lot of people don't know, but the tax code has this rule called the alternative minimum tax. And that's basically a provision that ensures that high earning taxpayers, high wealthy taxpayers, are paying a minimum amount of income tax. And before the TCJA, the alternative minimum tax thresholds were not really that high. The TCJA bumped them up, meaning less people had to kind of deal with the AMT. So one of the big questions that tax practitioners have right now is how the SALT cap, this increased SALT cap, is going to work with the AMT. If you're a high earner and you're claiming the SALT cap, you might get thrown into AMT and actually not really get the full benefit of the SALT cap. I think there will be some taxpayers who get caught up in that mismatch, but I will say that the big beautiful bill did maintain the higher exemption levels for AMT. So hopefully, for a lot of people, it won't be too bad, but planning purposes, this is something you want to look at now. You do not want to wait until April 15th and then realize you have a huge tax bill.
Let's touch on energy credits, and then we'll jump to a couple topics specifically for business owners. So energy credits, of course, came into play with this bill. Can you give us an update on what this policy looks like now and whether it's going to stick or probably change in the future?
Sure. So, one of the big things when President Biden was in office, the Inflation Reduction Act was passed. And under that piece of legislation, tax credits for the renewables industry were given a huge boost, both in terms of, how much credit you could get, but also a lot of new credits were put into the tax code. And so, for example, Section 45V, the clean hydrogen production credit. And so since then, there's been sort of this whole exploding market in the renewable space and investors trying to figure out how can we, work with producers and really get the benefit of these tax credits. Not surprisingly, there are a lot of Republicans that don't love these policies. They don't really want it. From their view, they view it as they're subsidizing the renewable industry, and they shouldn't be. So one of the things that many congressional Republicans said with the big beautiful bill was we have to roll back some of these credits, both taking away credits and also we'll leave some in, but we'll reduce the amount, or where maybe the credit was going to be open for a 10 to 15 year period, now that's going to be cut down to 2 or 3 years. So the bottom line is that the big beautiful bill does really pare back tax credits in the renewable space. There's a lot more restrictions now. They're not as valuable. That being said, my own view is that I think the future of tax policy is going to be in the renewables and energy space. I think in the 1980s, right, our government was having so many discussions about depreciation methods and deductions and how that could help and hurt the economy and maybe, boost growth. And that was sort of like the main tax policy discussion and debate. And I think now we're kind of moving into a new space, which will be focused on renewables. So even though right now, as of today, there was a lot of paring back of those credits, I do think that they're going to come back at some point. Will it be in a couple of years or will it be in 10 years? I don't know, but I think that's where the future of tax policy is headed.
So we work with a lot of business owners. I'm sure you do too. Things that affect them, right? There have been changes to the qualified business income deduction and restoration, preservation of the pass-through entity tax deductions. So can you educate us on both of these deductions, how they may benefit or hurt business owners?
So the qualified business income deduction was a new deduction that was put into the code in the Tax Cuts and Jobs Act. It was one of the many provisions that was set to expire at the end of this year. And what it does, in simple terms, and it is more complex than this, but simply, It allows individuals that have their businesses in some sort of pass-through form, so whether they're a sole proprietor, whether they have an S corporation or a partnership, they're able to claim a deduction of up to 20% of their qualified business income. The main reason this was added to the Tax Cuts and Jobs Act was not because Congress was feeling super generous. The main reason is that one of the sort of watershed things that the Tax Cuts and Jobs Act did is it lowered our 35% corporate income tax rate to a flat 21%. And that was permanent in the TCJA. It's not scheduled to sunset. So what Congress was afraid of is that, with the corporate rate, massively being reduced, we've got a lot of businesses in the US that are held in pass-through forms in S corporations and partnerships. Now we're going to have this huge shift where everyone's trying to be a corporation because now the tax rates just don't make sense. So really that deduction was put in because Congress was like, oh yeah, if we lower the corporate tax rate that much, it doesn't really match with individual rates that pass-through entities have to deal with. So that's why that deduction was put in, the primary reason. So that was one of the big things that has now been made permanent in the big beautiful bill. Initially, the Senate was thinking about increasing the deduction from 20% to 23%. That did not make it in. I suspect, again, because of the scoring was the primary reason. But one of the things to remember about that deduction is it only applies to non-specified service, trades, or businesses. And how I like to think about that is the tax code has never been kind to doctors, lawyers, accountants, and financial advisors. If you're in those professions, you're a specified service, trade, or business, you don't get the benefit of this deduction. This type of deduction, I always jokingly say this is for people doing real things, right? They're making something, they're selling something. This is not for doctors, lawyers to be able to use this. And so that's still in the Tax Cuts and Jobs Act. One of the things, though, that went along with this is there was a proposal in the big beautiful bill to curtail the use of what's called the pass-through entity elections, PTE elections. And these elections are actually elections that taxpayers make at the state level, so not federal, but state level, where they say, so I'm in Pennsylvania, right? So I'll use Pennsylvania, where they say to the state of Pennsylvania, I have a partnership. Normally, the partnership itself would not pay Pennsylvania state income tax, but I'm going to make that election and have the entity pay the tax instead of me individually. And the reason is that after the Tax Cuts and Jobs Act, the IRS blessed those types of state level elections for business owners to get around the SALT cap that was put in place. So because the state income taxes were now being paid by the entity and not the individual, they didn't get caught up in the SALT cap, and it gave those business owners the opportunity to go ahead and claim, kind of an increased SALT deduction on their return, where other taxpayers don't really get that benefit. And so Congress was thinking in the big beautiful bill about potentially adding some legislation that would curtail this and change the rules. It did not survive. So, people will still be doing, making PTE elections. I think that's going to be a part of regular accounting practice from now on.
And something that hasn't received as much attention in the media is qualified business stock. So can you talk about the tax benefit, the changes in the big beautiful bill, how it's going to impact small businesses, particularly for business owners that want to sell assets?
So this is a really huge provision. It has not gotten a lot of attention in mainstream media. Obviously, tax practitioners are excited about it as a planning tool. But basically, so there's a provision in the tax code that says if you own what's called qualified small business stock, and you hold it for a certain period of time, and then you sell it in the future, you get to exclude up to $10 million of taxable gain from that sale of stock. It's an incredible, powerful planning tool when all the stars align. And I say that because to be a qualified small business stock, there are several requirements you have to meet. It used to be one of them was a 5-year holding period, which sometimes was a lot. You can't be an S corporation, you have to be a C corporation. And the business itself can only have up to $50 million in assets. Now, though, with the big, beautiful bill, this provision has been given a pretty good boost. So that $50 million level is now $75 million. The $10 million exclusion has been bumped up to $15 million. And now that 5-year holding period, there's actually a phase in where if you hold it for 3 years, you'll get to exclude some. If you hold it for 4 years, you get to exclude more. And then once you hit that 5-year mark, you can do the full 15 million. And so what this is going to do, it's going to do 2 things. First, it's going to change a little bit when someone's just starting a business. It's going to change the discussion on choice of entity. So typically, tax practitioners are allergic to C corporations and always say use pass-throughs. Now I think we're going to see a lot more people revisiting, gee, should you be a C corp? Does this special, provision work for you? So that's one thing, choice of entity discussions. And then the second thing it'll do is it'll open up for like the M&A tax planning world. If you're selling a business, if you were planning on this benefit, it's going to put a lot more pressure on M&A negotiations on the structure, because typically buyers want to buy all your assets, sellers want to sell all their stock. And now I think you're going to have sellers basically demand and say, no, I planned into this exclusion, so I have to sell my stock. I can't sell you my assets. To get this, I have to sell the stock. And that, I think, is we're going to start to see that. We're already seeing it in the M&A world. It's coming up, but it's just going to be supercharged now. And I should mention, too, that qualified small business stock treatment is another one of those provisions that it does not apply to doctors, lawyers, accountants, and financial advisors. If you're in those sorts of service businesses, this is not for you, again, because the tax code is not designed for that. But it's a huge thing, and I do think mainstream media will pick up on it very soon.
Well, Chrissy, thank you so much. You have shared just like an immense amount of knowledge with us about the big, beautiful bill, and I appreciate to our audience for watching. Hope you enjoyed this, and we will see you next month for another episode of Coffee with Alissa.
Thank you.